Welcome to AM Best Audio.
Welcome to this AM Best Analytical Briefing. Directors and Officers Insurance, State of the Market. I'm John Weber with AM Best. Over the next hour, a panel of AM Best analysts and industry leaders will discuss the latest trends shaping directors and officers insurance. We're going to meet our panel in just a moment. Now, we may mention the subject of financial strength ratings. A full explanation of AM Best ratings is available on our website at ambest.com. The opinions expressed by our non-AM Best panelists are theirs and theirs alone and do not necessarily reflect the opinions of AM Best. Now, if you have a question for our panelists, please use the question feature on your screen, and we're going to do our best to recognize it during our program today. And now let's meet our panel. First of all, we say hello to Peter Carrozza. Peter is Regional Head of Private Company Management Liability, North America, Allianz Commercial. Peter, great to see you again.
Great to see you as well. Thanks for having me.
Next, we welcome in Kevin LaCroix. Kevin is Executive Vice President, RT Pro Exec. Kevin is also the author of the popular blog, The D&O Diary. Kevin, good to see you again as well.
Good to see you again, John.
Also today we have with us Sarah Abrams. Sarah is Executive Vice President, RT Pro Exec. Sarah is the co-author of the D&O Diary. Sarah, welcome to the panel.
Thank you, John. Nice to be here.
And last but not least, here in our studio, we have David Blades, Associate Director, Industry Research at AM Best. David, as always, great to have you aboard.
Great to be here, John.
And David, we're going to kick things off with you today. Can you start by giving us an overview of AM Best's new D&O report?
Sure. So in our recently published D&O report, we focused on the current elements of the D&O market, and we kind of juxtaposed them, the favorable aspects of the market with some challenging elements of the market that we think bring some caution in terms of where we think the market may be going. The recent results for the market have been excellent in terms of profitability, but at the same time, there are emerging and evolving risks that corporate officers are facing, and the fact that you have the risks that are increasing from those evolving and emerging things, and the fact that we have premiums that have been going down for a while. The question is the sustainability of the recently profitable results, and that's kind of what we had as a focus on one of the main themes of our report. I have a couple of slides here that we can kind of go into to show some of the main things that we tried to bring forth in our report. And if we look at the market from a standpoint of headwinds and tailwinds, and we'll focus on the tailwinds first, as I mentioned, the recent underwriting performance has been favorable for monoline writers of directors and officers liability. And we're able to look at the premium and loss information from the annual supplement that's in both the annual and quarterly statements that the insurance companies file. From a results standpoint, the direct incurred loss ratios for the last 5 years have been highly favorable, and they've been lower than the loss ratios that we saw at the end of the 2010s, right when the market got sort of to its most competitive point. And that's important because, again, the market has been softening in recent years. So looking at the results in these years and comparing them to 2018 and 2019 gives you sort of a bar to look at to see how the market is looking now and to have some idea of where we may be looking from a going forward standpoint. The declining pricing and premium trends, what we've seen from the standpoint of pricing and the softening of pricing, we think based on our surveillance of the market that we are seeing those things stabilize. But that's going to, we'll see how that continues to play out because, again, how the market reacts in these next couple of years will show us how sustainable the current profitable trends are. And like I said, with things getting even more complicated in the world, our hyper-connected world, in terms of some of the risks that are facing corporate officers, directors and officers, we'll see if they're able to maintain that profitability. One of the things that makes us feel a little bit more strong in terms of where the market is now and the ability to continue or to sustain the results is the underwriting approach that as we talk to our rated insurers, they talk about the current D&O market. They talk about having learned lessons from the recent market, again, where results got to the point where in 2020 and 2021, rates needed to be increased in order for the sustainability of the marketplace in terms of getting results back to where they needed to be. And we think those companies, as they've talked to us, they've learned lessons in terms of how they're approaching the limits that they're providing, and also in the coverage grants they're providing, the terms and conditions. So we do think that there is discipline with regards to how the market is being approached and how underwriters are approaching their D&O risks. And that's, again, another tailwind that we think is in favor of results being sustainable. Looking from a headwinds standpoint, there are increasing exposures for corporate officers, let's say arising from new technologies like artificial intelligence, where there's just much greater scrutiny on corporate officers in terms of their disclosures and in terms of their management of AI and other technologies, some of the other technologies that might lead towards cybersecurity breaches and things of that nature. So all these things are on the plates of corporate officers, and so these are some of the increasing exposures that we're talking about that they have to continue to manage and try and manage successfully. Unfortunately, in the world today, we're all too familiar with geopolitical strife and the impact that can have, the difficulties and pressures and challenges that can create from a macroeconomic standpoint. And again, that just creates more pressure that corporate officers have to deal with in terms of decisions that they're making, how they're managing their company's way through these issues, and whether there are any missteps made that could cause any kinds of financial losses to the company. So again, geopolitical uncertainty is another one of the headwinds that we're looking at. Securities class action lawsuit settlements, they increased in 2024, went back down again in 2025. So there's been some variance as far as that's concerned. But I think what was more telling in 2025 is that there were more AI-related security class action lawsuits. So again, that exposure, the AI exposure, coming more into the fore and potentially bringing different risks for corporate officers. I think that's something that, from our standpoint, caused us to take some pause and look at what that might mean on a going forward basis. And then last, we did see, and it's difficult to identify loss reserve development specific to D&O because the D&O line of business is not one that's specified or doesn't have a specification on the annual statements that companies file. But in looking at the other liability claims made line of business, that's generally where you'll find majority of the D&O business, and that there's been some adverse development on certain accident year reserves from that perspective. So as we look at that, that's another one of the headwinds that we continue to look at in terms of what we're seeing and what's going to be impactful on a going forward basis for D&O insurers. Just the key takeaways from our report. Again, competitive market pricing. Again, it reflects robust capacity. It reflects great interest, whether it's from private equity or from newer companies that are still looking to grow. But at the same time, that growth and what it's doing to overall pricing conditions could squeeze profit margins. So we're looking at from that standpoint in terms of what pressure that puts on directors and officers. D&O liability direct premiums, as I said, because of those pressures and because of the competition or the heightened competition, the premiums have declined for 4 consecutive years now. And so again, we'll see what that means and how long that can be sustained while loss ratios continue to be favorable. There's been lesser demand for transactional coverage in recent years, like IPOs and SPACs, but that activity has started to trend upward a little bit in 2025. So again, if we're starting to see more activity in those kind of transactions, that could bring more the potential for loss that directors and officers are facing. And just because things have gotten more technologically complex, the general risk profile of commercial policyholders continues to shift and continues to grow and present new and complex risks for insurers to have to deal with, whether it's from geopolitical concerns, whether it's economic concerns, or whether it's just the profile of the company, how they operate, and what that brings to brings to the fore in terms of the risks that they're facing. So, corporate officers, or insurers of directors and officers have a lot to deal with in terms of managing all those exposures and making sure they're making the right decisions from a risk selection standpoint, from a pricing standpoint, and then handling claims in an efficient and effective way. And then the last thing, and we're looking at, again, the direct loss ratio that it actually did increase for the first time. Again, had been trending favorably in the last several years, but I have another slide here where we can see the direct loss ratio in 2025, for the first time in a couple of years, since 2022, it actually increased about 5 points in 2025. So we're wondering, from an AM Best standpoint, if some of the risks that we're worried about, if some of the risks, whether it be social inflation, third-party litigation funding, whether it's just, like I said, the premiums coming down and getting to a point where they're no longer fully covering some of the risks. We'll look at that, but this is the first year in the last couple that the loss ratio has gone down. We'll definitely be continuing to look at that on a quarter-to-quarter basis and looking at that in 2025 in terms of what that means for the marketplace. But you can see 2021 and 2022, those are the years where there was a benefit from the maybe 18 months of hard market activity in 2020 and 2021 that elevated the premium level, but like I said, consistently been going down since then.
David, what are AM Best views on key factors affecting current D&O liability market conditions and how they affect the near-term outlook for the segment?
Okay, so the easiest way to answer that is to talk about the market segment outlook for AM Best. And AM Best actually, during the first quarter of this year, I believe it was in February, we revised our market segment outlook to stable from negative for D&O liability insurance, owing to some of the following factors. Again, we mentioned loss ratios have been favorable, but like I said, sustainability is the issue there. We talked about recent rate declines, but the fact that we think they're stabilizing, and we'll look to see if we're continuing to see those trends still be evident in the first half data that will soon be aggregating, and obviously looking at things from a full year standpoint. Again, we do think that insurers have been doing a better job sticking to their principles and sticking to their underwriting discipline. Again, taking into account lessons learned from the previous market or the previous soft market. So we think that's another reason why that we felt strongly enough to move the market segment outlook to stable from negative. And we also looked at regulatory scrutiny and the fact that it's changing. It's not so much, I think when this new presidential administration came in, a lot of thoughts were like, oh, we're pro-business and it's going to be, much easier or much better for the corporations. I think what they've done is they've shifted their scrutiny from a regulatory standpoint. So whereas they came out hot and heavy against DEI measures and ESG related measures, I don't think that things are that much easier for corporations. I just think the scope of what the regulators are looking at has changed. But because some of that has eased somewhat, that's also another positive factor that as we look at regulatory scrutiny that insurers companies are facing. Offsetting that, like I said, the abundant capacity that's fueling the high level of competition and what that's going to do to the premiums and to the rates. Rising claim severity, as I mentioned, social inflation, third-party litigation funding, trends such as those that are impacting D&O insurers and what that's doing from that standpoint. Again, we'll continue looking at that, but that's another potential key offsetting factor. And then just the emerging and evolving risks from the standpoint of corporate directors and officers, whether there's new technologies, like I said, or any of the other risks as there's more that's put on corporate directors and officers from a disclosure standpoint, from just regulatory scrutiny. There's just a lot for them that they have on their plates now to manage in this, again, hyper-connected global world where they're operating in from a business standpoint. So there's a lot from that perspective.
How have recent macroeconomic shifts such as tariff changes and inflationary pressures specifically impacted the underwriting performance of D&O insurers?
Well, I think when we look at what we think tariffs and things like that, how they've affected the market, you got to remember D&O is a long tail line of business. So the tariffs that were initially implemented, there were some fits and starts with those tariffs, right? Some of them, they came out and they were pulled back. There was some temporary relief from them. So I think we'll continue to see that factoring through. I don't know that we saw or that we can point to anything in the 2025 numbers, even though, again, we did see the loss ratio go upward. But I'm hesitant to pin that on some of those things, although we will continue to look at that. And if we see trends as we look at some of the claim numbers and some of the loss reserve numbers, if we do see some evidence that it's really, some tariffs and some of the other macroeconomic factors, or geopolitical factors that are having a specific impact. But I think from that perspective, I think, some of the inflationary pressures, like I said, social inflation, definitely, I think that's played a part. But I think that was already in the marketplace. That was already affecting claims that were already in place and playing their way through the claim process and coming through in the numbers. I don't know that tariffs in and of themselves, that how that impacted corporate entities factored into the numbers yet, but we'll continue to look at that.
Last question before we bring our guests in. Given the data trends shown in the report's claims and loss reserve charts, what insights do you draw about the long-term sustainability of profitability in the D&O segment?
Well, I think that's where, again, we have some pause with regards to what we're thinking about on a going forward perspective. And I have another slide here. And the key thing to remember here is, like I said, there's no line of business in the annual statement that's specific directors and officers liability that we can get claim information from. So we're looking at and we focused on the other liability or general liability claims made line of business. Now, when we look at the calendar year 2025 loss reserve development, what we saw is that in 2023 and 2024, as the market, as the competitiveness of the market began to impact premium levels, we see now that the reserves for those couple of accident years have trended or have developed adversely. Looking at, and you juxtapose them or compare them with 2020 to 2022 when that were benefiting from really strong premium numbers because of the premium increases in 2020 and 2021, those years decidedly were favorable from a loss reserve development standpoint. So again, we're continuing to look at that. If 2025 were to have another year where we see, or if in this year we see that 2025's reserves develop adversely and we see continuation of what we saw in 2023 and 2024, that will portend somewhat more negatively in terms of the effect that loss reserve development is going to have on the calendar year profitability of D&O insurers. I also think it's interesting in this slide that older years like 2018 and 2019 still had some adverse development in there. So we're hoping to put those in our rearview mirror from the standpoint of those underwriting D&O liability, but those years, very modest, but still had some adverse development. And last thing I'll bring up is that when you look at the percent of reported claims that are still open by year, the key thing I think in this slide is in 2018 and 2019, when you compare them to 2023 and 2024, the percent of claims that are staying open after the 2-year period or 24 months, and even comparing that 3-year period, it's been the numbers a little bit higher in terms of how long the claims are the percentage of claims that are still open. Open claims will generally mean higher loss adjustment expenses. That generally means also that that can reflect the impact of social inflation, of third-party litigation funding, of claimants and plaintiffs looking for higher settlements or staying in or keeping their claims open as they anticipate or hope for higher claim payments. And so we're thinking from that standpoint, that's something else we'll continue to look at, because that particular trend, again, it's not terrible now, but it is beginning to trend in a troubling direction, and we'll see how that looks.
Thank you for that very comprehensive presentation, David.
No problem.
Peter, we're going to start with you here now. Where are you seeing the most acute risk trends emerging?
Thanks, John. And thanks, David. Well done as always. Yeah, look, the risk landscape for directors and officers continues to not only broaden, but deepen in multiple areas. And we're certainly seeing an increase in underwriting discipline around these trends. A lot of the trends being discussed in the D&O community today were being discussed last year, but have continued to gain traction. When Allianz published our 2026 D&O Insights report, we identified several converging trends that are holding true as we reach the halfway point of 2026. Geopolitical instability sits at the top of the list. The number of active state-based conflicts reached its highest level in 7 decades in 2024. These conflicts and more recent conflicts in the Middle East have cascading effects, right? Trade disruptions, sanctions exposure, supply chain matters, all of which create liability exposures for executives who are held accountable, right, for how well they anticipate and adapt to these dynamics. So geopolitical uncertainty and the resulting economic impact is a trend to closely monitor. Of course, AI, right? It's quickly climbing to the top of the list. On the Allianz Risk Barometer, AI surged from number 10 in 2025 to number 2 in 2026, as far as what our clients are concerned about. AI adoption is creating new exposure around board level oversight, disclosure obligations, and decision-making liability. And then there's the insolvency trends that we're seeing in North America. Business insolvencies rose 7% in 2025 and are expected to rise 5% in 2026, which would mark 5 consecutive years of increases and creates a persistent structural tailwind for D&O claims. And lastly, of course, cyber-related incidents continue to be a key focus for boards. In this digital business environment that we operate in today, and will continue to operate in into the future, it's imperative for boards to pay close attention to their cyber risk management.
Sarah, Peter talked about geopolitical risk. How is geopolitical instability reshaping D&O risk exposures?
Well, thank you so much, John. And I think as Peter kind of hinted at, and David also stated during his excellent presentation, the inability to have certainty when a board or executives are attempting to disclose the impact is tremendous. So having that type of geopolitical instability, especially when there are supply chain issues, and I think as David described, we live in a global world, is that we are ensuring that we are attempting to place risk, are trying to determine amongst tremendous uncertainty what a geopolitical event, especially in conflict, might mean for their businesses. We've also seen with respect to securities litigation, how those disclosures or lack of disclosures, a regular matter, may end up leading to allegations of malfeasance against the executives, against the board. And I think, that last piece on cybersecurity that Peter identified does tend to increase with geopolitical instability, especially when there are sanctions that are being put in place and foreign nations may need to find capital. Oftentimes, that may come through hacking or backers attempting to access systems, and even that lead to oversight Caremark claims, as we've seen come down the pike. So I think just that geopolitical stability as a whole really can lead to a tremendous amount of additional risk that Ds and Os will have trouble identifying in publicly filed disclosures. And then the Monday morning quarterbacking comes into play.
Sarah,
John,
go ahead.
I'm sorry, John. I just wanted to jump in. I want to echo everything that Peter and Sarah said. I just want to point out that there are these trends, but there are also claims. There has been claim activity. There have been lawsuits filed against companies alleging that they soft pedaled their exposure to the tariff impositions or downplayed the impact the tariffs are going to have on their financial results or business operations. But in addition, there's been a wide range of other types of claims arising out of other geopolitical concerns, including export controls, trade sanctions, anti-money laundering, even migration control. And there have always been those kind of claims. That isn't necessarily new, but the point I wanted to make is the number of those kind of claims in the last 18 months or so has been significantly higher than we've seen historically. So it's not merely that there are these macroeconomic trends and geopolitical trends that are affecting companies' operations. They are translating into claim activity, then it will affect the claim volume in any given accident year and the reported results in the accident year as well.
And just to pick up on Kevin's point, I think that's something that, when you asked the question about the impact that tariffs and geopolitical concerns have had on the results we're seeing now, I think as Kevin pointed out, some of these claims are still working their way through the system. And I think hopefully those numbers and some of those trends will be a little bit more clear as we get through, let's say, the end of 2026. I think, again, specific to the tariffs and to some of the geopolitical strife that we're dealing with now, it was still maybe too early to really pinpoint how they're impacting the numbers, just looking at 2025 data. But I think we'll hopefully see some more clarity on that when we look at full year 2026 data.
Sarah, what D&O concerns arise when companies face sudden tariff changes?
Well, again, as Kevin alluded to, we're already kind of seeing these claims percolate, this litigation bubble up. And despite, the IEEPA tariffs being struck down by the Supreme Court, new tariffs were then put in place. It goes back to, what we talked about with geopolitical risk. The inability to have certainty surrounding disclosures can be problematic. And then with respect to the litigation that involves tariffs, it's really what will be successful for plaintiffs' counsel. Right now, we've seen tariff litigation that involves consumer practices. So I think about the litigation that involves Sony or Fabletics. It really had to deal with how were tariffs being passed through? How were companies able to absorb these tariffs and still be profitable or meet what they anticipated would be their profitability and disclose to the marketplace? So really, again, I think with respect to tariffs, that litigation is beginning. David's right. And we're starting to see how claim development, even if those consumer lawsuits aren't necessarily triggering D&O quite yet, the impact or what that litigation might show us about that company, its strength and ability to disclose in a way that the market expected could ultimately lead to D&O claims.
Peter, you've noted the importance of underwriting discipline in recent commentary. Can you elaborate on what that looks like in practice today?
Yeah, look, the AM Best report does a tremendous job, covering the rate trends and the analysis against the last market cycle. And I think the title hits the nail on the head. Still profitable, but warning signs are evident. And I really think underwriters are heeding that warning, against the backdrop of softening rates. And in the simplest terms, underwriting discipline means resisting the temptation to chase premium at the expense of adequate pricing on an individual account as they make up your portfolio, right? So, and I'll put an emphasis on individual accounts and the importance of underwriting them to their own merit when you consider adding it to your portfolio. Now, at face, it's refreshing to see that D&O pricing remains 33% higher than 2019 levels. But, keep in mind, the dollar isn't what it was in 2019. $1 in 2019 is $1.31 today, according to the Bureau of Labor Statistics. The cost to defend a claim, to bring a claim to resolution, continues to rise, with not just social inflation driving this, but true inflation over the last 7 years. And you add in the complex risk environment we're facing between these geopolitical and economic pressures, as well as risks brought on by AI and even cyber-related impacts on businesses, right? So, in recent years, a nice shiny car rolling onto the lot may have received multiple bids on the spot. Now there needs to be a thorough inspection under the hood and if possible, a test drive. I'm not a car person, but I feel this captures the transition of underwriting behavior in the market over the last year, right? So in practice, this means asking questions and really understanding how companies are managing their key exposures. It means being thoughtful about attachment points, retentions, and terms rather than simply matching the market. And I think most importantly, and what we train all of our underwriters to do is to think long term when you're structuring a program for an insured. Risk profiles continue to evolve, and underwriters want to understand how executives and their boards are managing these, not just for this year, but for the years to come.
So
John,
let's
if I may, John, I've lived long enough that I've been through several market cycles, and I've sat at different seats at the table. And to me, the question for any underwriter playing in the market today, are they willing to let business walk away if they're not getting the price they think they need? And it's very hard to be the only disciplined market. And it's very hard if you're running an underwriting facility to answer to your managers about shrinking premium. Your expense ratio goes up. And so underwriting discipline is a phrase I think everybody worships and acknowledges, but it's actually quite hard. And I think it's very hard to be the only carrier being disciplined in a market, a shrinking market. And the carriers that maintain their discipline will, as Peter said, live for the long run. But it's very hard to do in a competitive marketplace, to watch a piece of business walk away. And that's when you really have to test whether there's underwriting discipline or not.
Peter, while pricing has softened in recent quarters, capacity and retentions remain inconsistent. How are you guiding clients through these market dynamics?
Yeah, look, and I absolutely agree with Kevin, right? Really putting that underwriting discipline into practice. And look, I do feel the market today, it's still bifurcated to an extent, right? And the advice that we give clients reflects that. For well-governed companies with favorable performance that are in these sectors with minimal acute emerging risk exposure, the buyer environment, it still remains favorable, and the terms they receive tend to reflect that. There is still ample capacity available for companies with favorable risk profiles, but we are seeing carriers become more selective. Even at excess layers on towers where pricing thins out, especially for higher risk sectors where a tower can be susceptible to a claim, the premium just has to make sense. So look, our guidance to client centers on two things. First, take the market opportunity to thoroughly review your coverage structure, right? Your limits, your retentions, your terms, rather than treating the renewal as an administrative exercise. Second, invest in the quality of the submission and the renewal process, right? Address your key exposures and what's being done to mitigate them. The underwriting scrutiny around AI governance and geopolitical and regulatory risk management is real, and a submission or discussion that addresses those areas proactively will generate better outcomes than one that does not. I'll tell you, some of the underwriting meetings that we've been sitting in over the last few months are the most engaging I've ever seen in my entire career.
Sarah, is ESG still relevant considering the current political climate?
Absolutely. In fact, I think it's even more relevant now, given how we've seen targeting by state attorney generals as of late in litigation where antitrust is being levered in ways we couldn't have anticipated, both from, historically red states, some that have targeted asset managers for allegedly colluding to place their investments in funds that were, again, more sustainable in terms of the environmental impact, less environmental impact, allegedly anti-coal. And then we've also recently seen by blue state AGs litigation requesting the DOJ clarify what anti-DE&I means for contractors. Again, these kind of risks are developing related to that E, environmental, the S and G in a very different way that I don't think was anticipated by companies who felt that a new administration may not be focused on climate and may have different types of initiatives that, again, were focused on kind of the anti-DE&I. Companies were anticipating that there may be regulatory scrutiny one way. And now we're seeing a fragmented approach where the states are themselves taking matters into their own hands? And how do you advise, again, a company when you did not anticipate that certain types of laws were going to be applied to prosecute? Those are expenses. And those expenses may, depending on the claim that's brought, impact the D&O program.
John, I have one observation about ESG, if I can. There's in the current administration, there's a policy approach that I think could fairly be characterized as anti-ESG. And, I think it begs the question whether ESG is dead. And I would say nothing has changed other than the politics. And the fact is that corporate boards still need to run their corporations, still need to make the important long-term decisions. So what I would say is the decisions companies are making today or not making are going to be at the core of lawsuits that are filed 5-10 years from now about whether the boards manage their companies in a way to ensure that they are sustainable, they have redundancies that protect them from interruptions in their business operations and even financial results. And so I think it would be a mistake for corporate boards to think that in this current environment that ESG is a dead letter and that it's not a topic that need concern boards. I think that would be a very dangerous conclusion for boards to make.
David, the report highlights evolving technology as a factor. Can you elaborate on the types of tech-driven exposures that are most pressing for directors and officers today?
I think we've definitely already put the spotlight on one, just thinking about artificial intelligence and how it's become more prevalent in terms of operations across all types of industries, and in that way, it's become more of an enterprise risk. How companies, from a top-down standpoint, are managing it in terms of how they're looking at their appetite, how much of it they even want to take on, and then how they're going to lay off the risk, and also how they're going to control it. So I think from that standpoint, I think AI, whether it's you're talking about algorithm failures and the claims that could bring from that standpoint in terms of whether it's derivative lawsuits or class action lawsuits or just regulatory scrutiny. Looking at just when you think about AI, number one thing people might think about in terms of exposures is AI washing, misrepresenting or just overstating the use of AI or how AI is being used in operations or within a product, et cetera. So I think AI in general is creating a lot of the exposure from a technology standpoint, but I think there are also other technologies. Any technology that has access to, real important or private information within a system, and the fact that cybersecurity is so important. Any technology that can be breached or where companies can come up short from a cybersecurity perspective, I think that can lead to claims. And then when you think about it in terms of technology-related insureds, and you think about their exposures from a D&O standpoint, cyber standpoint, and also from a technology E&O standpoint, there could be coverage gaps depending on how programs are put together. So I think some of the, like I said, the evolving technologies and the risks that they're facing are many and varied, and I think it's incumbent upon companies and the insurance companies to work and ask as many questions as they can to really understand the exposures of their insured companies, and then just to stay on top of being able to manage those exposures the best they can, because it's very, very challenging, especially in the highly litigious times that we live in.
Sarah, how do you see D&O underwriters viewing AI risk?
Well, I think David really succinctly described what the concerns are, especially because AI isn't necessarily a single risk. Companies are deploying different types of artificial intelligence, whether it be predictive, generative, agentic, and they're deploying it at the rapid rate that artificial intelligence is developing. And so I think the question becomes, knowing that we've already seen claims that could include AI washing, but also claims that could involve other types of deployment of artificial intelligence by a competitor or by a platform that a company relies on. We've already seen those types of securities claims develop. as a result of artificial intelligence being implemented. So at this point, there's a reason why Peter mentioned it as well. Artificial intelligence, not only is it on top of mind, but underwriters are deciding if they want to absorb the risk. So there are underwriters that are seeking to exclude artificial intelligence from coverage. And then there will be underwriters, given the soft market, who will continue to either absorb it affirmatively or view it as kind of a silent AI risk that they're willing to take on. So again, I think it's, considering the type of developing artificial intelligence claims we've already seen, the impact, whether those claims will be successful, and then how companies and underwriters are deciding to address the artificial intelligence risk that is here and, clearly evolving on the daily.
Peter, David, and Sarah both mentioned AI washing, and a viewer writes in asking, what are underwriters seeing in the way of increased incidents of AI washing claims, and what can accounts expect that have no reliance on AI technology?
Yeah, that's a good question. I know Q1 of 2026, AI-related security lawsuits, I believe, were double the pace of 2025. It's really hard to say. Again, going back to my commentary about underwriting and account to its individual merits. When we sit in these rooms and on calls with executive teams, and we get to ask these questions about how they're using AI, and sometimes it's an imperative piece of their operations or the product that they're selling or the services that they're offering. And, okay, we want to understand what the guardrails are, right? How are you actually using this? How are you monitoring this? How are you measuring the efficiency of implementing AI or using AI? And yeah, look, some of those insureds that aren't necessarily, heavily impacted by AI, of course, right? There's not going to be as much scrutiny around it. But it really comes down to the individual account and underwriting to its own merit.
John, this is Kevin. If I can jump in there, there may be companies out there that aren't using AI in any way. I'm skeptical. They may exist, but every other point of access in their universe is responding to the evolving AI. Their customers, suppliers, vendors, regulators, third-party bad actors, they're all using AI. And I think that's important because there's not only been AI washing claims, which several of us have mentioned already, but there have been claims not of overstating the prospects or opportunities of AI, but understating the risks of AI. And those risks include not only risk from a company's own deployment of AI, but the risks to the company and its operations and financial results from those other constituencies of adopting AI: vendors, customers, suppliers, regulators. So I think even the company that's living in a cave and is managing to do all of its processes without engaging in AI in any way, even if such an organization hypothetically exists, they still face AI risk exposure. It's a pervasive risk, and I think that's critical to understand where the claims are going to be coming in the future. They're not just going to be AI washing claims. They're going to be claims of under disclosure of AI associated risks, which may be third-party risks.
Peter, private company D&O has often flown under the radar, yet exposures can be just as severe. Are you seeing increased claims activity in this segment?
Yeah. Private company D&O it's an area of growing claims focus, and I think it deserves more attention than it's received historically. I think private company D&O flies under the radar in the sense that there generally isn't as much headline risk and volatility as the public D&O or financial institution space, right? Those segments tend to be higher risk. They tend to have larger premiums, which draws attention from carriers and creates more susceptibility to volatility in pricing. The historical stability of the private market and really just the sheer scope of opportunity, given that 99% of businesses in the US are privately owned, has led to more carriers investing in private D&O to capture market share and to balance their portfolios. This increased competition, of course, has impacted rates, but it also results in coverage getting broader, right? Keep in mind, private D&O products already provide broader coverage than public D&O products, particularly for the insured entity. So broader terms mean policies are more susceptible to be triggered and provide coverage that that may not have been provided during firmer points in the market cycle. Regulatory enforcement actions are among the top source of private D&O claims. Bankruptcies are as well. The current business environment, marked by economic and regulatory challenges, is generating exactly the conditions that produce those claims. And look, I know this is the state of the D&O market, but I'd be remiss to not mention, right, employment practices liability, or EPL. Many of the carriers writing D&O also write EPL. For private company, a lot of times those coverages are purchased as part of a package policy. And the risk landscape for EPL has shifted, and the many catalysts for EPL claims in recent years, including layoffs, are driving activity. So, you factor in higher wages, rising costs to defend and settle claims, as well as these higher verdicts becoming more frequent. It's having an impact on the EPL market, all while retentions have been suppressed by competition in recent years. And, as carriers look at their portfolio, if there's changes needed on the EPL, well, it's more inclined to go to market, and the D&O goes with it, despite whether that line has performed well. So I do think that's going to have implications for the D&O market as well.
Sarah, is private credit an underappreciated risk? And if so, can you explain?
Well, I think that the risk for private credit is beginning to be appreciated. There was another article in the Wall Street Journal today about a large private credit firm having another increase in percentage of requested redemptions. So I think that the press and the conversation that's happening within our marketplace is certainly bringing this particular risk to the forefront. And to dovetail on what Peter said, in terms of this private company liability and private company D&O, private credit touches that as well, especially if it was a private credit lender that provided capital to one of these private companies. It can create distress depending on the terms of the private credit financing that was provided. So I think private credit, it was a very favored asset class. It was having a large amount of return on investment that was favorable to those initial investors. However, during the periods of economic stress that may be caused by interest rates staying higher, the private credit market is also seeing an impact. And we're also getting more information about the opacity with which the private credit industry was valuing companies that it was providing loans to, especially if they were private. It wasn't marked to market. So it could be a private credit asset manager levering internal valuation to then invest in a company. And the allegations that we're seeing now made against some of these firms, especially the publicly traded ones, where that opacity kind of led to valuations which were not appropriate, as well as the returns are not going to be coming back to the investors. And that lack of redemption is creating that heightened scrutiny. The SEC has also indicated that they're beginning to evaluate private credit firms. And there were also not big name private credit lenders who got into providing private credit. I've heard of real estate firms who decided to become private credit lenders. And then you also saw larger banks that decided to include it as part of their asset strategy. So while I do not think it's underappreciated at this moment, I think there is concern that this is just the beginning. And the talk about potential contagion, given how many different players are invested in private credit, has real potential to have a longer tail for claims and potential exposure to D&O underwriters, both on the private and public company side of this conversation.
John, this is Kevin. If I can just jump in quickly, just to pick up on what Sarah was saying, I think one of the reasons perhaps private credit is being more fully recognized as a risk area is that the claims are starting to accumulate. They actually began in 2025 with claims involving private credit borrowers, two very high-profile bankruptcies involving Tricolor and First Brands. Those were sort of the canaries in the coal mine, if you will. But since that time, there have been a number of claims against lenders, high-profile lenders, picking up on the kinds of things Sarah was just mentioning, alleged misrepresentations relating to asset valuations, to redemption policies, the quality of the loan portfolio, or the quality of the due diligence procedures the company was deploying, the level of concentration in certain industries. Apparently, software was a favored source of lending or borrowing rather for these creditors, and so the claims are accumulating. And so I think the luxury of not paying attention to the problems in this sector is something carriers no longer have. That the claims alone would alert them to the fact that there are problems. And I completely agree with Sarah that this has a long way to go before it's fully developed.
Sarah, a viewer asks, given the apparent pullback in regulatory oversight and enforcement of checks and balances, do you think this may increase the risk of D&O misconduct and lead to greater volatility and unpredictability in D&O exposure?
Well, I think that's a great question. I think that may be happening in some cases, but as Kevin indicated earlier, with the conversation surrounding ESG, just because there's a pullback in regulatory scrutiny at this period in time doesn't mean that with each election cycle, there wouldn't be potential whiplash. So those companies who may have backed off better corporate hygiene and governance focus and structures which make them good risks are still not necessarily going to be good risks, and in fact may put themselves and their Ds and Os in a precarious position should there be a change in the administration, because with that, agency heads change and initiatives change, as we've kind of seen before this current Trump administration and then the administration prior. So that could be happening with some organizations, but certainly if underwriters are staying disciplined, since we all like to use that term, and focused on kind of that good disclosure corporate hygiene, hopefully, you can survive what may appear to be less regulation now, but could end up being a higher risk in just a couple of months or maybe in a couple of years.
Peter, how should brokers and insureds be preparing for renewals heading into 2027? And are there common missteps you see during the submission process that can still be avoided?
Yeah, great question. From an underwriter standpoint, I would say to brokers and insureds that the submission process is increasingly becoming a key underwriting conversation, especially for insureds with more complex risk profiles. The risks that are driving D&O exposure require real engagement, and carriers are differentiating between insureds who demonstrate thoughtful management of these risks and those who may not. The most common missteps that we see, companies that have experienced material changes in their business, whether it's a leadership transition, a significant acquisition, or an entry into a new regulatory jurisdiction, and don't proactively explain those changes. Underwriters doing their diligence are, and they discover that reactively rather than proactively. It creates friction in the process, and it can erode confidence. So tell your story, be open for dialogue. Underwriters truly appreciate that, and it can lead to better results.
Sarah, of all the trends that you're tracking in the D&O marketplace today, which one do you think is still being underestimated by boards and senior executives?
Well, I think this operational risk that we kind of have talked about with these larger macroeconomic factors that keep causing pressure on companies. So it's not having certainty and then attempting to either not disclose or disclose in what is considered by shareholders an ambiguous or wrong way what the actual risk factors to the business itself are. So more of these securities plaintiffs are expecting, and they're saying, we wanted a board to understand what the potential risk was that was tied to artificial intelligence being integrated into our systems, or competitors using artificial intelligence, or the vendors that use artificial intelligence. And so I think kind of this, again, it's a governance and operational risk converging. The expectation of appreciation by Ds and Os of how this tremendous time of change, both, again, there's geopolitical impact and change. There's also technology change. How are Ds and Os supposed to appreciate, understand that change, and then how are they supposed to disclose that to the marketplace? And I think that is what we're seeing already in claim development, allegations in these security suits, and then what's being watched by shareholders.
Peter, do you have some thoughts on that as well?
Yeah, I think if I had to identify, a trend that's being underestimated, it would be the intersection of artificial intelligence and disclosure liability. It's important to understand AI. It's not apparel. It's a technology that is still evolving and evolving quickly. It's a pattern familiar from earlier cycles. A new technology attracts enormous investor attention and higher stock valuations. Companies make public statements about capabilities and strategies that are difficult to substantiate, and when results disappoint, that's where the exposure is created. So I really think AI, it must be subject to the same level of control as any other statement a company makes.
All right, well, we just have a couple of minutes left, but before we close out, Peter, I want to ask, looking ahead, what macroeconomic or geopolitical developments do you think could significantly influence the D&O market in the next 12 to 18 months?
It's so hard to say what could happen, right? I look back a year ago from now and all that's changed since then. But in terms of what we're seeing today, the trade policy environment remains a watch point, particularly the impact to accessing export markets and reshaping supply chains. Any geopolitical escalation that significantly disrupts financial markets or triggers new sanction regimes creates a rapid and cascading D&O exposure across sectors. The regulatory environment around AI, of course, right? I know in Europe, it's becoming increasingly concrete as the EU AI Act's obligations are phasing in, and the personal accountability frameworks it creates for directors are real and enforceable. That's a developing exposure from that I think the market is bracing to understand, and is likely to come into sharper focus over the next 12 to 18 months. And lastly, M&A and IPO activity will continue to play a key role in the U.S. Lower deal-making activity is one of the factors contributing to an imbalance of the supply and demand in the D&O insurance market. When M&A and IPO activity is down, there's less opportunity for carriers to write true new business, and it leaves them to pursue existing buyers, which in turn can drive rates down.
All right, well, this has been a great discussion today. Before we close things out, I'd like to go around the panel and get everyone's closing thoughts on what they think the big takeaway is here today. And Kevin LaCroix, let's start with you. What would you like registrants to remember?
Well, the D&O insurance industry is subject to supply and demand, and I think we can all get comfortable, at least us on the buyer side, that it's a buyer's market. But the cycle will turn, and I think it will be important for all the players to be prepared for a changing insurance market. Sarah alluded to it earlier about the possibility of AI exclusions being added to D&O policies. We could, with a changing in the cycle, face a very different insurance environment. I think it's important for all the participants to understand what the implications are for the availability of coverage on attractive terms and conditions for the insurance buyers.
Thanks, Kevin. Sarah Abrams, what's your big takeaway here?
Disclosure risk, certainly. Even with uncertainty, even with such fast moving development from a technology perspective and factors outside of corporate control, which include, again, geopolitical instability, what do disclosures look like? Is there good corporate hygiene? Still have compliance structures in place, even if there's an indication that there may not be as much federal regulatory scrutiny, states still may be scrutinizing how companies are doing business.
Thank you, Sarah. Peter Carrozza, what would you like registrants to remember today?
Stay with the trends, right? Remain a student of the industry. There's so much that impacts D&O insurance, and I said it last year. I'll say it again. Uncertainty presents risk, which is the core driver of the insurance business. It also presents opportunity.
Thank you, Peter. David Blade, you get the last word today.
I think it's funny, as we were listening to the last half of the webinar, I think the question that you asked Sarah about private credit being an underappreciated risk and the answer she gave, I think was almost perfect. And I think for somebody who's really trying to understand, because private credit is being talked about a lot now, or a lot more now, and I think understanding the risks that are associated with it and how it's impacting corporations, and then really understanding that we're still at the beginning of understanding and how that's manifesting itself. I think that was a tremendous answer. I know Kevin actually added to it, and I think that was just something, it just struck me how good and how well that was captured. And the second thing, Peter talked about insurance companies effectively engaging their policyholders and their commercial risks to truly understand, as these companies change a strategy or go into a new territory or take on a new product, really understand that you have to disclose that to your, the brokers and insurance companies really need to talk through all the elements of that to fully understand what D&O risks are prevalent, and it can be coming out of that change in operations to really make sure that the coverage that's there is fully comprehensive. So those two things struck me when we were talking about those two particular issues.
All right, thank you, David, and thank you, panelists, one and all, for an outstanding presentation here today. We would like to let our viewers know that we will have a full replay of this briefing posted within the next day or so. We'll have a full transcript out within the next week or so. For AM Best, I'm John Weber.
Looking to get the full attention of the insurance industry? We have the platforms that will do just that. Whether it be AM Best TV, AM Best Audio, Best Review Magazine, or Best Day. Find out more by calling AM Best Advertising Sales at 908-439-2200, extension 5399, and have a great day.